All right, all right, all right. All right, let me talk a little bit about my bearish outlook on the stock market. As you know, I've been saying that the market is due for a correction and we're actually short the market up here, and I've been advising people to raise cash. Now, let's break it down. Fiscal remains really, really strong. So that is an at least in let's talk about the macro, the underlying conditions, all right? You may recall that I had mentioned the very, very significant deceleration in bank credit, particularly loans and leases, and within loans and leases, really commercial and industrial loans. I mean, the slowdown was, those things just fell off a cliff. And the growth rate in loans and leases almost approached zero year over year when you look at it at a year-over-year basis. It popped up a little bit last week. We had an increase in commercial and industrial loans in the week ending January 8th by the biggest amount in 6 months. But the growth rate is still very sluggish. It's only 1% year over year. So I was talking about that. I was talking about the slowdown in lending. I was talking about the collapse really in refined petroleum product demand, particularly distillate demand. Has really, really collapsed. Slowest demand in 3 years. It broke a 4-year uptrend. Gasoline demand is very weak. If you look at inventories, obviously, of refined products, gasoline, distillate, that wouldn't happen in a very strong economy. So you have those indicators to look at. There were also some other things that I mentioned, which were weekly claims for unemployment benefits. The continuing claims were at the highest level in a year and a half. The 4-week moving average of claims was at the highest level in 2 years. We saw a relatively weak job report, earlier this month. So we had a bunch of things there. Now, on the flip side of that, fiscal remains incredibly strong. And that's my thing. That's my core thing. Fiscal remains incredibly strong. Fiscal is what I look at. But you cannot ignore what's happening with banking and bank credit. So that to me was an indication, as well as the other things that I mentioned. Maybe the bank data is now, maybe that was a pause, all right? So set all that aside, you still have a market that is very overbought. I'm talking technical stuff here, which is merely not, necessarily a thing I focus on. Sentiment is very important. You've had a big rise in bullish sentiment. You have now, for the first time in a long time, I think since April of 2019, we see that the neutrals, those are people uncommitted to the market. They've been sitting on the fence the whole entire time. They've been watching the market go up. And you may recall in many videos that I made last year in 2019, I said the market is going to keep going up until those neutrals finally throw in the towel and jump off the fence and buy the market. And we saw that happen in the latest week. They finally jumped off the fence. We finally got a neutral reading below the historical average. That thing was elevated above the historical average for the entire year of 2019. And they were sitting on the fence and sitting on the fence. And you had so many opportunities to buy, or they had so many opportunities to buy. And they finally jumped off the fence and started buying. What else? You have institutional asset managers. The most long S&P futures since January 2018, all right? And we had some big corrections in 2018, culminating with that huge market correction at the end of 2018. So you have a lot of sentiment stuff. You have the put-call ratio right now, the 10-day average of the put-call ratio at the lowest level in 6 years, right? A low put-call ratio suggests a lot of optimism, a lot of call activity, a lot of call volume. So you have these indicators. What I'm more concerned about is the actual economic conditions that we're looking at. So you have on the one hand very strong fiscal, you have on the other hand what looked like a pretty significant slowdown in bank credit, loans and leases. Maybe that was temporary. In any case, the market is overbought, valuations are stretched, sentiment is very bullish. So we will get a pullback. The question is that just something that's going to clear out some of the bullish sentiment, or is it based on a slowdown? If it's based on a slowdown in the economy, then it would be much longer lasting than any sort of a technical or sentiment-based correction. But this is what we have to keep an eye on. I'm saying there's not enough information now. There's not enough data. I want to look at the banking data again that comes out on Friday. And the fiscal is very strong. We can't ignore that. That is there. That is a bedrock of support for the economy. But you still need that bank credit going on. So anyway, all that's happened. And I have to say, we were short oil in that run up to 59, 58, high 58, 59. Then we had the whole assassination thing. You had the spike. We stayed short. Every week I come out with my very, very detailed EIA weekly petroleum status report analysis. That was bearish. It's been bearish. I said stay short, stay short. We covered a little bit today in the low 57s. All right. And so I think the market's going down to 55, maybe low. Look, if the economy slows down and if the market corrects significantly, oil's going down a lot further. But right now, I've seen there has been some commercial oil interest buying at these levels and also at 55, so we're pulling in some of those shorts. So I guess that's the update for today, folks. All right. Stick around. Maybe I'll put out another video later. Bye-bye.